just a few months after the Federal Reserve began to raise interest rates to fight inflation. Chairman Jay Powell was clear about what those actions might do to the economy. But by fall, more than 60% of economists surveyed by the Wall Street Journal, including Diane Swonk, predicted a recession in the coming year. But now, almost a year later, it still hasn't come.
The economy has performed stronger than most anticipated and stronger than the Federal Reserve would have preferred, which suggests some unsustainability. Employment levels have been higher than what business conditions would typically support, presenting a mixed blessing. So the question arises, are the Federal Reserve's rate hikes effective, and what factors are maintaining high inflation rates? Initially, goods inflation surged during the pandemic, peaking at over 9% year over year, but it has since moderated to around 3-4%, depending on the metrics used. However, this doesn't imply that prices are decreasing. Why has the US avoided a recession so far, and are we achieving a soft landing? It appears that the robust employment sector is a significant factor, driven by businesses' heavy investment in hiring during the labor shortage, making them hesitant to lay off workers. This reluctance has likely postponed a recession, though it remains a possibility. Traditional indicators, such as the yield curve, leading indicators, and the sensitivity of small businesses, which must quickly adjust to changing economic conditions, continue to signal the potential for a recession. Typically, recessions start about 2 years after the Federal Reserve begins raising interest rates, and we are currently at that mark. It's believed the Fed will eventually lower rates, but is cautious to ensure inflation is thoroughly addressed first. Why would they be in a hurry? There's no definitive sign that the economy is deteriorating. With employment remaining strong, the Federal Reserve feels no immediate pressure to lower interest rates. It's true they have a history of overshooting their actions, both in tightening and loosening monetary policies. However, they seem more cautious this time around. Regarding the labor market, you mentioned layoffs, but we're still seeing strong job growth. The contradiction isn't as stark as it seems. The gap between job openings and employment gains is narrowing, suggesting a cooling in the labor market. Other factors like wage increases, especially in the service sector where wages are rising by 5 to 6% annually, far exceed the Fed's inflation target of 2%, presenting a significant challenge. These signs of potential weaknesses could lead to layoffs in various sectors, likely a delayed reaction to current conditions. Layoffs can trigger a cycle where reduced incomes lead to weaker spending, impacting business sales and profits. As for which industries are most at risk, it seems that service sectors, which have been strong, are vulnerable. Services tend to be less volatile than goods, but they are not immune to economic pressures. For example, regardless of economic conditions, people still need haircuts, but discretionary services like beauty treatments might see reduced demand in tougher times. Certain services are inherently stable, much less volatile than goods. However, this doesn't mean there aren't many discretionary services. For instance, post-pandemic, there's been a surge in people seeking out dining and entertainment options, driven by cabin fever. Recently, my wife and I tried booking a table at our preferred restaurants for the weekend, only to find them fully booked, a clear indicator of discretionary spending. Despite these trends, there are signs that people are becoming more cautious with their spending. Shifting focus slightly, considering it's an election year, the outcome could significantly influence our economy. The contrasting economic policies of President Trump and President Biden could shape our future. President Biden has shown a propensity for increased spending, which is typical as elections approach. President Trump, known for his unpredictability, focuses more on strict immigration policies and protectionism, especially concerning China. Each candidate's approach offers a different philosophy on spending, trade, and immigration. While these differences might not immediately impact the economy, they hold potential long-term effects depending on the economic context at the time. When the economy falters, it's instinctive for any president or Congress to increase spending. However, if the economic downturn isn't severe, the focus will likely shift to specific issues like immigration and protectionism, depending on the election outcomes. Regarding the future of globalization, it isn't so much declining as it is evolving. It takes time for countries to develop their industries to the level that China achieved over the past 4 or 5 decades. However, this is progressing quickly in countries like Vietnam, Bangladesh, and India. I'm particularly optimistic about India. It offers several advantages over China. It's a democracy, it has widespread English usage due to its British colonial past, and it maintains a legal system, albeit imperfect. Additionally, while global birth rates are declining, China's have plummeted due to its one-child policy, potentially diminishing its workforce and its influence globally, unless offset by significant productivity gains. As for investments, I'm bullish on the US dollar and treasury bonds, which are considered safe havens during uncertain times and might benefit from anticipated lower inflation and potential Federal Reserve easing. I'm also betting against commodities, specifically copper, which is a key indicator of global industrial activity. Historical data over the past 150 years show a consistent decline in the inflation-adjusted prices of commodities. Now, if you like this video, check out this next video right here.